So this video is to give you the solutions to one of the problem sets we did in class. This problem set says on the front of it, record transaction, and there are 9 transactions that I'm going to talk about. So the first one is that it says the company issues $100,000 in a long-term bond, which is a debt, and the bond provides a payment of interest twice each year at an annual rate 8%. The bonds are payable 10 years from this date. So what it's telling us is that, first of all, $100,000, we're getting a loan for $100,000. It's called a bond, but it's just like a loan. And it has 8% interest, and it's payable in 10 years, which means it's going to be long-term. The 8% part of it is not part of our equation because we don't have to pay that for 6 months. It says it's paid twice every year. So the transaction here is that we have $100,000 cash that we got, and then we have long-term debt that increased on that. The next transaction says the company signs a contract with Watchdog Security to provide services for July, from July 1st, 1998 to June 30th, 1999. And remember, right now it is June 1998. And the contract calls for the payment of $2,000 15 days after the close of the month in which the service was provided. So what that tells you is that on August 15th, we're going to have to pay for services we had in July. And that's pretty important because we are only concerned with June. So there is actually no record with this particular transaction. So transaction number 3, the firm receives a check for $6,000 from one of its customers for payment of merchandise that was delivered in January. Okay, so what that is telling us is that a customer took merchandise, didn't pay us cash for it. Actually, what we did is we created a accounts receivable for that money that she owed us. And what that means now is she's paid some of it. So we're going to have an increase in cash of $6,000 because we got payment for that, and a decrease in an asset, which is a credit entry of $6,000. So a debit entry, an increase in asset, credit entry, a decrease in asset. The next transaction, the firm purchases 100 shares of Exxon stock for $80 a share. And this is a short-term investment. So what this means is they see they have a whole bunch of money in cash, and they're saying, well, gosh, that's a lot of money to be sitting here. Maybe we should make an investment with it. So they do. They went ahead and bought Exxon stock. So they had a decrease in the cash account of $8,000 and an increase in short-term investments of $8,000 for the Exxon purchase. The next one says, okay, this stock price went up. Well, we actually need to remember when we record transactions. In accounting, we only record transactions when they occur, when something happens. Nothing's happened. The stock price has gone up and down, and in fact, it goes up and down all the time. And are we going to be recording that change every moment? No, we're not. We're only going to record it if we sell it. So number 5 does not require a transaction. Number 6 says the company purchases manufacturing equipment for $84,000. The company pays $20,000 cash and gives a 3-year note for the balance. In addition, the company incurs costs of $2,000 to install the equipment. So we know part of this, we're going to have $84,000 worth of equipment. So we're increasing our asset, which is a debit entry. We're going to decrease it by the $20,000 cash that we paid, and we're going to increase a debt, a liability, which is a credit entry of $64,000. So this 64, this 20 is equal to this 84. In addition, we paid cash of $2,000 to install the equipment. And if you remember from 314, you might not remember if you didn't have it, of course, but what you have to do is this value needs to be put into an asset, into the long-term asset, because it's part of putting that asset into service. The next is the company issues 10,000 shares of its stock for $12 a share. What that means is we're going to end up increasing, our equity of $20,000, $120,000, which is 12 times 10,000 shares. So we have more owners. It's an increase in equity. We're also going to increase our cash because we sold part of the company for $120,000 cash. So we have more cash now. The next is we're going to pay rent for office space, but it's for the month of May, which is the previous month. and it had been recorded as an accrued rent payables. So here I have a rent payables. There's some value in here in a liability here of the money we owed, because last month we didn't pay rent. And we recorded that we didn't pay it as saying we actually have a payable. We need to pay that rent. So this month we're paying for May, so we take $600 out of cash and we decrease a liability. A decrease in liability is a debit entry of $600. What happened in this transaction is that we received items last month and we looked at them this month and we said, oh man, this is not good stuff. We inspected it, it's not good. We're going to send it back. So physically what we're doing is taking our inventory and we're going to decrease it because we're sending it back to the supplier. On the other side of it, we didn't pay cash for it. We created accounts payable, we increased a liability, we put some value here, and what ended up happening is that now, since we're returning it, we're going to decrease that liability of $900. So this is a decrease in the assets because we sent it back, and a decrease in what we owe our suppliers. Now I hope that video helped you a little bit how to figure out this transactions. Bye.